Tom Forrester, your Forrester Value Fund is up almost 2% in a year, where the S&P is down around 9%. So let's start off with you telling me how you do it.
Well, first off, we start with a great portfolio of large cap value stocks. We try to find stocks with low PEs that are underloved, that have great appreciation potential. And then in times where we're concerned about the risk in the market, we also hedge the portfolio with puts, S&P 500 puts. And so it's a great downside protection fund, but still getting some good upside as well.
Well, one stock that you're long in the Forrester Value Fund is Spectra Energy. It's down almost 19% in the past year. That said, it's held up better than a lot of the other pipeline players, has a nice 5.6% dividend yield. Tell me why you like it.
Well, it's a recent ad for us, and so the stock going down actually helps the valuation, so we thought we bought it at a very attractive price. But right now, think about this. Okay, so natural gas has been pretty washed out for a couple years now, unlike oil, which is still trying to find its bottom. So we think the bottom's probably in somewhere, we're near the bottom for natural gas. This is a natural gas pipeline. It's growing in the Northeast as people shift from heating oil and other things, and coal, to natural gas. And so think of this is like a growth utility, if you will. It's growing EBITDA by about 10% a year. It's got a 5.5% dividend, and it still has an attractive valuation. So we think it's got a lot of upside. And
you also like Tyson. Now the chicken seller's up around 14% so far this year, in what has been a very tough year for stocks. In their last quarterly report, they beat on earnings, missed on the top line, although the street seems like they've forgiven the company. Tell me why you like it.
Well, they've got they bought Hillshire Farms last year, right? So they're starting to move more into prepared foods, which have higher margins and higher growth, and away from just kind of the commodity side. Last year, they had problems with beef margins. That's coming back now, and so you saw that in the quarterly update. So we think that they had fixable problems when we bought it. We still think they have some fixable problems, and they're on their way of fixing that. We think it's got a lot of upside to it.
And then finally, you are a fan of Pfizer. Tell me why you like this great Irish company. They're going through this tax inversion deal with Allergan. They're going to be based out of Ireland. It's going to lower their tax bill. You don't think they're going to get a whole lot of blowback from that?
You know, they fit the guidelines that the Treasury set up. You have to own under 60% of the new company, which they will do. So we don't think that'll be a problem. It'll cut their tax rate from mid-20s down to mid-teens. So we think that's a big boon for them. That's not in the numbers right now. Also, one thing that's hit Pfizer over the years is they had a lot of big blockbuster drugs that came off patent, and so they're getting hit by that. They're anniversarying most of those this year. And so we think now you're going to start seeing growth in that, and so the headwinds will be gone. And we think a lot of the negatives to the stock are gone, and they still have a lot of good growth, new drugs that are coming up right now. So we think low valuation, good growth ahead, and better tax rate. We think that's a no-brainer.
All right, well, thanks a lot, Tom.
Sure.
And thank you for watching The Street.